Good afternoon. My name is Desmond Lochman, and it's my pleasure to welcome you to this event on monetary policy in the 21st century, an Allan Meltzer perspective. At the outset, I'd like to thank David Beckworth of the MacArthur Center for suggesting that we at the AEI host a monetary policy event honoring Allan Meltzer. I should also mention the fine book that David has edited on reflections on Allan Meltzer's contribution to monetary economics and public policy, to which John Taylor, Ed Nelson, and George Selgin have all made valuable contributions. And David will have more to say about the book in his remarks, and I think the book is available on display later on. It's more than fitting that we at the AEI host an event on what Allan Meltzer might have made of the current direction of central bank policy. After all, it was here at the AEI, not actually in this building, but in the old building, that he made his home when in Washington, and where he wrote a definitive history of the Federal Reserve. As an aside, I might mention that it was my good fortune and privilege to have had Allan Meltzer as a neighbor at the AEI while he worked on his history. And I recall learning so much from the many discussions that were always lively and informative, and including anecdotes about his meeting with Margaret Thatcher, with Milton Friedman to try to convince her what to do. But the discussions I had with him were on the European Central Bank's role in the Eurozone debt crisis, which was very much alive when we were neighbors. I also recall how inspired I was by the fact that well into his 80s, Allan would regularly drive down from Pittsburgh to Washington, and he would listen to lectures. He told me that he didn't waste his time on this drive. He would listen to lectures. And whenever I asked him how he was doing, he would always reply in his 80s, on an age-adjusted basis, he was doing very well. One of Allan Meltzer's main criticisms of the Federal Reserve, which has all the more relevance in today's challenging monetary policy world, was that the Fed tended to over-respond to short-run events and neglect the longer-term consequences of its actions. In this regard, he was particularly critical of the way in which the Fed made things up as it went along, and the way in which several rounds of massive quantitative easing had seriously distorted credit markets. It would be an understatement to say that today we live in unprecedented monetary policy times. Let me cite a few examples. Despite some tapering, the combined size of the balance sheets of the world's major central banks, and I'm talking about the Fed, the Bank of England, the Bank of Japan, the ECB, are still some $10 trillion larger than they were in 2008. As a result, the US, Japanese, and European central banks all still own a sizable share of their respective government bond markets. Another way to look at this phenomenon is that it took the Federal Reserve 100 years to increase the size of its balance sheet to $800 billion, yet it took only 8 years after the 2008 Lehman crisis for the Federal Reserve to increase its balance sheet by a further $3.75 trillion through 3 rounds of quantitative easing. Another example of the strange times that we live in, the ECB's main lending rate has now been negative for some time, as have a number of other central banks in Europe. Perhaps even more striking is around 1/3 of the world's bond market, or some $17 trillion, now trades with negative interest rates. As an example, the whole of the German yield curve, including 30-year German bunds, now bear negative interest rates. One now has to pay the German government around 0.75% a year for the privilege of lending it money for a 10-year period. This morning, matters seem to get even more bizarre in that Greece, a country with a debt-to-GDP ratio of a mere 180%, joined the club of countries that can place bonds at negative interest rates. Another disturbing part of the global monetary landscape, at least it disturbs me, is we now seem to have a massive disconnect between the world's sovereign debt markets and the world's equity and credit risk markets. Negative European government bond yields and a seriously inverted US yield curve are all signaling that we might be headed for a US and global economic recession next year. At least that's what is implicit in that pricing. Meanwhile, the world's equity and credit risk markets are still partying like there's no tomorrow. That actually puts me in a good position because I can make a statement with a great degree of certainty that economists generally can't make, is that one of these markets is wrong about the future. The last point I would make is that the ECB is now engaged in another round of quantitative easing, and President Trump is calling on the Fed to both radically reduce interest rates and to engage in another round of massive bond buying. It is at times like these that we all miss Allan Meltzer's valuable monetary policy insights. However, I'm pleased to say that we have with us today a strong panel of experts whom I've asked to provide their views on these matters, as well as to comment on what Allan Meltzer might have made of today's monetary policy world. In the order in which they will speak, they are Professor John Taylor, who certainly needs no introduction, being a senior fellow at the Hoover Institution and a professor of economics at Stanford University, and after whom the famous Taylor rule is named. David Beckworth is a senior fellow at the Mercator Center at George Mason University and a former international economist at the US Treasury. Ed Nelson is a senior advisor at the Division of Monetary Affairs at the Federal Reserve Board. And finally, George Selgin is a senior fellow at the Cato Institute and a professor emeritus at the University of Georgia. So with that introduction, please join me in welcoming the panel. Didn't quite get the seating arrangement right, but Professor Taylor, would you like to begin?
You want me to start?
Yeah.
Okay. Well, thank you, Desmond, for a great beginning, and thanks everybody for coming. This is a very important day and a very important event because we're celebrating Allan Meltzer and his amazing contributions in this book, which has essays, of course, from all of us, but many other things as well. Very good reading. We're going to talk a little bit about what Allan Meltzer would think about today's situation. And I'm always hesitant to guess what people think who have unfortunately passed, because they could change. And people always ask me what Milton Friedman would think, and I'm usually hesitant. I could guess, I could put my words in his mouth, and that's what I'm tempted to do, but I'm going to try to avoid that. First, let me say that Allan, I had the privilege to be a very good friend. He reached out to me when I was just starting in economics as an assistant professor and invited me to the famous Carnegie-Rochester meetings in Pittsburgh. He knew that I grew up in Pittsburgh and had family there, so he figured, well, maybe it'll be a good conjunction of interest. And I went, and it was a way to learn more about what was happening in policy. That was a great thing, an example of how he was always thinking about reaching out. He also asked me to discuss a paper, a very important paper by Prescott and Kinland, which won a Nobel Prize eventually. That was the first time they gave it, I believe. And then most important, he invited me later, this would be 92, I think it was 1992, to give a paper at the Carnegie-Rochester Conference Series. In that paper, he said, why don't you've been writing about monetary policy rules for years and years. You just got off the President's Council of Economic Advisors, where there was a little chapter on policy rules. Of course, there was no equations in that. Maybe you could come and speak to our group about what you think. And so I wouldn't have done it anyway, but he had this opportunity. That was what he was good at. And so I wrote down one equation and talked about it, and that was the so-called Taylor rule, which I obviously didn't call it the Taylor rule at the time, but it became very well known, and I guess, to some extent it was Allan and his team. So I'm grateful, very grateful to him for that. And in many respects, I think that concept of rules, which he wrote about so much, would capture what he thinks should be happening today. One thing I'd also like to note about Allan is how really across the board multidisciplinary he was. He did many different things. He didn't stop at one little thing. And for example, he wrote a lot about monetary theory with Carl Brunner. But it wasn't enough for him just to write. He wanted to think about the institutions that made policy, the Federal Reserve and et cetera. So he had a book about that. It goes back to the history. Part of the reason for the Carnegie-Rochester Conference series was to have this interaction between the theorists and the policy. It was very successful. He also wrote a lot about policy mistakes. And here it wasn't enough just to point out the mistakes, and I'll talk about that in a minute, but why did these mistakes get made? And so his political economics came into play, and he thought a lot about how the policy was being made. Of course, he wrote a lot about monetary policy, but he didn't stop there. He wrote about other aspects of monetary policy more generally. And one of his last book was Why Capitalism? And he went through all the different aspects of our economic system, maybe a bit about monetary policy, but it was much broader than that. And he kept doing this. It was phenomenal. He spent quite a bit of his last few years at the Hoover Institution. We had a lot of discussions about that. He wanted to help promote the idea of a monetary policy rule, which there was some legislation in the Congress at that point. Jeb Henschling was behind it. So he said, John, why don't we get a letter together of people that would support this, and we'll send it in. And we did, and thanks to his leadership, we did. And Jeb Henschling read this letter, it's quite striking, to the chair of the Fed at the time in a hearing, Janet Yellen. And so it didn't pass. Well, it passed the House, but that was not enough. And it's an example of his wanting to be involved. There was we had a dinner for him at our house, he in Maryland, before that winter before he died, and it was amazing. He just talked about policy, and we all talked about policy, people who were there with me. It was just same old Allan, and of course there was current events. That would be very current events. So let me just say a little bit about the past and go to the future, to the future and the current events. So he was very much wanting to think of it as two kinds of policy mistakes or errors. One is just got the economics wrong, and the other had the politics. Politics were interfering. So you think about monetary policy. And he wrote a lot about the Great Depression. And I think for the most part, he thought it was a policy mistake. They were not aware of the role of the money supply. Money supply crashed as he measured it. And so it wasn't so much a political thing at that point, but he said this is an example, was mainly a monetary policy mistake. And then he wrote, of course, about the great inflation of the late 60s and 70s. And here he thought it was both a mistake, misreading the so-called Phillips curve, but also a lack of independence. And I've been thinking a lot about this recently. I'm doing a short book with George Shultz, who's a very good friend of Allan Meltzer. And it's amazing to do a book with George Shultz himself. He was there at the time. And he uncovered a memo that Burns wrote to Nixon saying, this is not working, we'd have to have wage and price controls. He was the chair of the Fed. It was amazing. And so, but it was also the lack of, less independence at the time, which I think was part of that problem. Then you have a relatively good period, I think, the so-called Great Moderation of the 80s and 90s until recently. And so Allan says, well, this is where they followed rules. He has examples of that. But it was also a period where Chairman Volcker and Chairman Greenspan, in effect, I think starting with Volcker, restored a lot of independence to the Fed. They made their decisions. It was a struggle, but it was very hard. And he got it. And then there's the global financial crisis, which Allan thinks it was both, going away from rules. He has specifics of that, but also loss of independence in the way he characterizes in his writings. And so that was a disaster. Let's face it, we're still feeling the pains of that amazingly disastrous thing for the world economy. But then we had this, I'll call it the not so great recovery from the Great Recession. And here I think Allan did begin to raise questions about quantitative easing. He didn't think policy was getting back to normal as quickly as it should. He thought it was an international aspect to some extent, which I certainly agree with and wrote about in a commentary at the Jackson Hole Conference, 2016, I believe. He raised his hand in a group of central bankers and monetary theorists and said, I want to make a point. We've got this very unusual policy, not just the US, we got it in Europe, we got it in Japan. And it's because of competitive devaluations. He used the word, it's competitive devaluations. First, the Fed does quantitative easing, drives the dollar down. And then Abe runs for prime minister. He wins, he appoints Kuroda, says, the yen's too strong, you do quantitative easing. We had quantitative easing in Japan, followed. And then Draghi does a talk in 2014, says, the euro's too strong. And so they do quantitative easing. So Allan said, this is not good. We've got to get out of this. And one way he thought we could get out of it is through the Fed. The Fed could start steering in a different direction, and that would influence the world economy. So I think to some extent, and this is the question about the current period, I think Allan unfortunately passed away, so we don't know, but I had the sense he would have been more positive about 2017 and 2018 because policy was sort of going back to what he thought it should be in the Fed. You had rates rising from 0 to 25 to a little over 2. And there's a lot of emphasis on policy rules at the Fed. The semi-annual report had whole sections. Never in history had it had that. It started with Yellen, went into Jay Powell as well. I think there's 3 different semi-annual reports, maybe 4 since then. And then you had Jay Powell explicitly saying that these rules are helpful. It's a good way to think about it. They were moving back towards rule. You had appointments like Clarida and Williams, of course, going to New York, and Randy Quarles, who had written much about this kind of way to think about things in the past. So that seemed all very promising. So you had the actions, the appointments, and the publications, and even speeches. I think, to my own view, that changed a bit sometime this year. We don't know all the reasons. I think some people write, well, it's just because the economy is weak. It's right on the rule again. It's not a deviation. We don't really know. It's less clear, quite frankly, than it was, I think, in much of 2017 and 2018. And so my guess, and this is a guess, that Allan would be saying the same things. Look, you were getting back to a more rules-based policy. That's good because we have so much history that when you deviated, it didn't work so well. That's what he would say. He said that. And so let's get back to it. And he would emphasize, I think more than most people, this international aspect. We forget about that, but he wrote a lot about the international economy. He served on the Meltzer Commission, which was to make recommendations for the IMF and World Bank, and I was Secretary of the Treasury just after that was released. It had an impact at the time. People read that and thought about, well, maybe we're giving too many loans, maybe we need more accountability. But that international perspective was always in his head, and I think we need a little bit of that now because we do have a global financial system, and financial markets are interconnected. I don't think it's a coincidence that we have quantitative easing in so many countries, or negative interest rates in so many countries, or very low interest rates in so many countries. It's an international thing, and of course there's different views about that, but that would be my view. It's the international aspect. And I believe, although we don't know for sure, that Allan would have been saying something about that. So thank you.
Before I turn to David, may I ask, could there be a problem that fiscal policy has been absent or has too much of the burden of getting recoveries going has been placed on the central banks. So for instance, I'm thinking right now in Germany, for instance, which is very reluctant, even though they've got their budget position in great shape, they're very reluctant to use the fiscal room they have to pump up the economy. As a result, what occurs is the ECB feels obliged to have another round of easing, and that might have the problem of distorting credit markets even more. So you get too much money flooding around, and you get asset price inflation, or you get ridiculous spreads. For instance, like in Europe right now, you've got high yield bonds yielding negative interest rates. There's something wrong. So my question is really, could a problem be that fiscal policy has been absent? And when we look into where we might be in 2020, the fact that the United States has used up much of its fiscal space, it's going to be putting the burden again on the Federal Reserve to engage in policies that might be a short-run fix, but just set us up for the next bust.
Well, first of all, I think it's a problem that the fiscal policy is where it is now. The federal deficit in the U.S. is $1 trillion, as far as the eye can see. We're almost every measure, we're at full employment. So what's going on? It's getting higher. I mean, no one seems to care. Do any of you care? I care, but what difference does that make? I think, and I know it's unusual. So it's not like we don't have enough. I think we have too much, and there's a reason to have a sensible, credible budget reform which deals with this problem. I think with respect to monetary policy in other countries, this could indeed be a way of thinking about things. But I think it's a mistake, because right now there are many people writing that the QE is having a negative effect. The negative interest rates are having a negative effect. I just got this morning a letter written by Otmar Issing and a former Helmut Schmidt and several other very distinguished monetary economists saying this has got to stop. We can't do this QE anymore. It's not working. These are very thoughtful, distinguished economists and policymakers. The Europeans are having tiering. So they have different rates for different size. Talk about intervention. And so I think that is a problem. There are different rates for different folks. And I think that there's many things that can be said about fiscal policy, but I think if you think of the biggest country, it's the U.S. It's going it's in a direction that needs to be improved. I think most people realize that, but it's very hard to deal with it. And I think the reason for the change that we've seen recently, the lowering of the federal funds rate, for example, I don't think it's fiscal policy. I think there's a sense in which we don't know the reasons for sure, but it seems to me the stated reasons are more weakness in the economy than was formerly perceived. There's talks about trade policy with uncertainty. Again, we don't know for sure. To me, if you look at history, you look at these rules, it says something else. And so to me, it's a bit of a deviation from what has worked before. Again, whether you have interest rate rules or money supply rules or whatever it happens to be. So I would not focus on that as the real reason. People do say it. I agree. It's put out there.
Thanks. Let's go to David. But what I'd like to do perhaps at the end is circle back, and just get views as to how do we cope with the next recession. That the recession could come for any variety of reasons. Whether it's an escalation of the trade war, whether it's Hong Kong, whether it's the Brexit, anything of that sort could tip the US and global economies into recession. A question that might be interesting to ask is, what do we do now? That fiscal policy looks like they've run too big a deficit, and monetary policy, interest rates are already at very low levels. What do we do? But I'll just throw that out as a question that we can come back to at the end.
All right. Thank you, Desmond, for inviting me here and for having us at AEI. And hopefully I can maybe touch on that question a little bit. So Desmond asked us, what would Allan Meltzer say to certain questions? Only have time for a few, so I'm going to mention two. But before I get into the questions, and like John, I'm going to confess up front, I'm speculating here, and it's very dangerous, so you've been warned. And the farther along this presentation goes, the greater the speculation on my part, so take what I say with a grain of salt. But I want to talk about the history of this book a little bit. It actually begins in November 2016. You see the picture on the screen there. Allan Meltzer agreed graciously to join me for a podcast in front of a live audience, and this was just about 6 months before he passed away. But he came, he joined. Honestly, I wasn't sure how it was going to unfold and happen, but he was incredibly sharp, witty. I mean, everyone was laughing. In fact, you can go online and listen to this podcast. You can hear the laughter from the audience. It really was a great time. And I just want to give one example of his wit during that conversation. We've been talking about the monetarist counter-revolution, a big change in the thought of economic thought in the 80s and around that time. And I asked him, I said, so what was the height of the monetarist counter-revolution? Was it Paul Volcker in the early 80s fighting inflation? Was that it? Was that the high of the monetarist counter-revolution? He goes, David, that was a short-run high. We'll be back. So he was very confident, very witty, and it was a lot of fun to have on the show. So that happened November 2016. He passed in May the next year. And then in January 2018, we have this conference we pulled together. It was on the margins of the American Economic Association meetings. We had the 9 presenters, and then John's paper as well we added to that, but they spoke to his work on the history of the Fed as well as his contributions to theory and then public policy. And then after that, we got our authors together. Hoover Press graciously agreed to publish it. Our pubs team at Mercatus, my monetary policy team worked hard. We knocked this out, and we're really happy about the book, proud of it, and hope you'll take a look at it afterwards if you haven't already. But to the questions that Desmond asked me, what would Allan Meltzer say? Again, I only have a limited amount of time, so I'm going to speak to two. What would he say about the Fed's inflation target misses? Why is the Fed missing its inflation target? What's the ultimate cause? And then what about its review? So this year the Fed's reviewing its targets. What would he say about that? So again, I feel bad at some level because I'm putting words into his mouth. And I'll just throw this little story out there. I believe it's 2010. I wrote an op-ed with someone else that got published, and I argued, what would Milton Friedman say about Bernanke's QE2? Similar spirit, and it really lit Allan Meltzer's fire. So he wrote his own op-ed in response to ours. So in tradition of that fun exchange, I'm going to continue today speculating on some thoughts. And I'm going to hopefully not be too far out there, but I'm going to speak about it. So first, just a recap of the Fed's inflation target. In 2012, it introduced a 2% target, PCE inflation target. The Fed, though, tends to look more closely at the core PCE measure. Many studies have shown the Fed was implicitly targeting 2% well before then, sometime in the 90s. And it was promoted by Ben Bernanke. So here I have my best Ben Bernanke. He's the Jedi Bernanke, and the force is good with his target. So the goal was to add credibility, to make it explicit. What we had known all along, let's make this explicit, because if we do that, then the market will expect it. There'll be more credibility. The market will do the heavy lifting, make our job easier. That was the goal of making this target explicit, among other things. And 2%, again, had been a number that had been in play for some time, but they came around to the explicit account in 2012. Well, as it turned out, things didn't turn out quite as well as they had hoped. This graph here is my way to depict what a textbook inflation target will look like. So I'm from the South, so you can see my use of gunshots here. But this is the target. In the middle is 2%. 3% is the top, 1% is the bottom. You're shooting at your target. On average, you hit 2%. That's the ideal, I would call, textbook inflation target. The average is 2%. You can't see the 2, but it's there in the middle. All right? So in practice, though, it didn't quite look like that. So the force wasn't so strong with this target after all. Instead of looking like that, the target looks more like this. It's been persistently below 2%. And I'll come back to this chart. There might be a reason why that's the case, and I'm going to come back to Allan to help us make sense of that. So there's something systematic that's causing inflation to veer below 2%. And this is what it looks like. I'm using core PCE inflation. The actual measure is PCE inflation, to be clear. But most of the FOMC likes to look at core because it's a nice measure or estimate of where the trend is going. So you can see there's been a below 2% pattern for a while. Okay, so what would he say? To answer that question about these misses, I'm actually going to go back to what he said about the 1980s and before then, the Great Inflation. So what did he say was the ultimate cause of the Great Inflation? And John already answered that it was monetary policy. It was a policy mistake. Politics were part of that as well, but ultimately the Fed could have done things differently had they tried. And this is a graph from one of John's paper with Andrew Levin. I'm actually going to draw on this story. I actually saw John give this at the AEA meetings once. He gave this talk, what really caused the 1970s inflation. It was an interesting time because he gave a talk with Andrew Levin that it was the Fed. Then right after him, someone gave a talk, well, it was supply shocks. And I won't mention the name, but some prominent economists, oh, no, you guys are wrong. It's all about supply shocks, 1970s. What this graph shows, though, is inflation takes off, expectations become unmoored. They also begin to take off. Those dashed lines show expected inflation from Leviton's survey. And just to state how much of a big deal this was, I came across this graph recently, and I searched this out because I recently interviewed for the podcast Robert Samuelson from here in DC. He's a journalist, and he made this claim in his book that concerns about inflation were the #1 concern in late 70s, early 80s, even more so than Watergate and Vietnam. I couldn't believe that. I was like, that can't be right. But I tracked this down, and hopefully you can read this graph, but those green lines, they're all green, the kind of middle green line there, which looks at inflation, under the question, what's the most important problem, in the late 70s and early 80s, you can see it hit 79, 83%. So not just a majority, but a supermajority of people viewed inflation as the #1 problem during this time. That's how big of a deal it is. And that's hard for me to understand. I mean, I wasn't really old enough to appreciate it, but it was such a big deal. People cared more about this than Vietnam and Watergate. And that's into the environment that Paul Volcker comes. And of course, this is from my interview with him. I'm going to draw upon that. But Allan Meltzer is very clear what happened. It was the Volcker central bank that really made a difference. And so I'm going to read from this interview. It's in the book. You can take a look at it. But I want to use this to kind of segue to what he would maybe think about today's low inflation. So he said the successful central banks, Switzerland, Germany before it joined the ECB, the Bundesbank, the Volcker period in the United States, they all controlled money. You want to keep inflation out, you want to control money. Milton Friedman said it correctly. Inflation is always and everywhere a monetary phenomenon. And so I'm going to go back, I'm going to tie this in. He loved the Bundesbank during this time. I'm going to go back to the story I was telling about at the conference where I saw John and Andrew Levin give this presentation, and then the other economist gets up and gives an equally compelling case of supply shocks. So, the average listener might be confused. Well, a third presenter got up and showed the case of Germany. And this to me was like a slam dunk case. Germany also was subject to the same supply shocks, high oil prices of the 70s, but they did not have the inflation we had. And this is a point that Allan Meltzer would stress. So just to highlight this, here is the inflation for the US. I'm going to compare it to Germany. So if it was truly a supply-side story, you would expect maybe Germany to see more of it. And in fact, it's the US. So Allan Meltzer clearly believed that monetary policy was the main culprit. Yes, there's all kinds of shocks, but trend inflation ultimately is determined by the central bank. And just to kind of paint this picture a little more clear, here's a trend through the US. You can see it takes off mid-60s all the way to the early 80s. And here's the trend inflation for Germany. So two very different stories. And Allan Meltzer would attribute that to the central bank performance. All right, so if Fed policy explains the great inflation that's lasted over almost 2 decades, decade and a half, then I think he might argue, again, I might be putting words in his mouth, that Fed policy explains a decade of low inflation. If monetary policy causes too high inflation that persists, then trend inflation that's too low for a long time might also be due to monetary policy. It can't just be transitory factors or bad luck, which is one of the explanations you often hear Fed officials give. It's a transitory shock. It was Amazon. It was this. It was that. But after a decade, it seems like at some point something could have been done differently. There's something systematic going on. Persistent undershooting, I think, can be seen as something systematic at heart. So going back to the chart I showed earlier, if you have a target that looks like the one on the right where there's this persistent undershooting of 2%, there's several things you could attribute to. One, maybe the gun's not working properly. Maybe the barrel's curved or something's not right. So maybe the mechanism's not working. Maybe the theory for using the gun's not right. Maybe you're not calculating the wind properly. Or maybe the person shooting the gun likes to shoot low. I mean, it might be it's a preference. But there's something systematic that's causing that to happen. And I think Allan Meltzer might say Federal Reserve, whether through what it wants or how it does it, is responsible for the below trend and below target inflation, which is part of the motivation for my next question. It's the review of its inflation target. So it's reviewing its inflation target for a number of reasons. One of them, because it's fearful of this low interest rate environment we're going into. But what would he say about it? My second question. And then what would he think about the makeup policy? So one of the things the Fed's looking at is a makeup policy. I want to explain what a makeup policy is. And then finally, what type of makeup policy? So let me just quick overview. I'm sure many of you know this already. But if we had a world where there's no supply shocks, no shocks, so the economy's going along fine, if you had a central bank targeting 2% inflation, whether it was a price level target or an inflation target, and nothing ever went wrong, the price level would grow and you wouldn't know the difference. Where the difference emerges with makeup policy is if you miss your target. All right, so here's an inflation target where there's, between year 1 and year 2, there's a period of deflation. The price level actually declines. An inflation target would just pick up and continue on. Bygones are bygones. That missed period there, it's water under the bridge. No worries, continue. So you can think of the slope of that line as being 2%. That downward period would be some period of deflation. That's what an inflation target would do. A price level target would make up for that. Say, no, we can't let bygones be bygones. Let's catch back up to where we would be. And what that would imply is that catch-up period, you would actually see a little bit faster inflation, faster than 2%. The slope of that line is steeper than the rest of the line. That means faster than 2%. So the Fed's talking a lot about make-up policy. Price level target's one version of that. Same thing if there's an overshoot. If there's an overshoot, inflation's higher than the 2%, then you would just keep going and you let bygones be bygones. A price level target would bring it back down. So you make up for past mistakes. All right, so what would he say about such makeup policies? And that's, again, one of the key things the Fed's looking at. If you look at the minutes from September FOMC meeting, you'd see it's been a big part of the conversation. Well, I'm really going out on a limb here, and Ed Nelson may want to correct me on some of these things, but I think you could say that at least some of this is consistent with what Allan Meltzer wrote. And I'm going to make the case this way. There's a sizable literature on the importance of permanent monetary base injections. And a lot of it is tied to the zero lower bound environment where there's a liquidity trap and you want to get out of it. There's a number of people who've written that you've got to have a permanent injection of the monetary base. It's got to be expected to be permanent, so expectations are key. Also, it's got to be greater than the monetary base demand. And I'm just going to throw a bunch of names up there, but these are fairly prominent people who've all written and made this argument. You can't have a temporary increase in the money supply or the monetary base. It's got to be permanent. And I would also maybe add the interest rate on excess reserves would have to be less than overnight rates to make this point work today. But this is the idea. And they weren't necessarily arguing for explicitly increasing the monetary base permanently, but they were saying this is what in effect happens if you have a price level target and you fall below it. To get back up to the price level target, you're effectively bringing in a permanent increase in the monetary base. And the thing is, Allan Meltzer made this same point many, many times. 93, 95 are two examples of this. He talked about there's a difference between temporary injections of the monetary base and permanent ones. So I think he would at least understand the case for makeup policy. He might even be sympathetic to it. All right, so what kind of makeup policy? Well, in the last few minutes, I've got to stay on message with who I am here. And I'm going to pull from the same interview, again, it's in the book, something he said I found very interesting. So this is continuing on from the earlier quote I mentioned earlier. He said, Milton Friedman said correctly, inflation is always an everywhere monetary phenomenon. If you keep reading, he meant the aggregate price level as opposed to something like an oil shock. Prices rise because of an oil shock, but that's not inflation in the sense Friedman talked about it. That's a change in relative prices. Then he goes on and talks about the 1970s, Arthur Burns. My SOMC, which is his Shadow Open Market Committee in 74, said that you got it wrong to Arthur Burns. This oil shock is a change in relative prices. There's no reason why you want to kill the economy by tightening money. What you want to do is you want to let the increase in relative prices pass through. So he stressed, distinguish between a change in the price level and a change in relative prices, or we would call that a supply shock. And you don't want to respond to a negative supply shock by tightening monetary policy. Well, what kind of policy does that? Well, a price level target has a hard time distinguishing between these type of shocks. And let me give you an example of a country that does something similar to this, and I'll end on this note. But I'm going to turn to Israel. Israel's my kind of poster child for the way things should be done in monetary policy. Some of you who know me, I know I make this point often. But the Bank of Israel actually has a 1 to 3% inflation target. It's a range. They don't have a point estimate like us. And if you look at different measures of their inflation, you see an interesting story. I'm going to look at the GDP deflator for them, and I'm going to compare it to real GDP. So first off, here's real GDP, all right? So you can see the Great Recession was very mild, but it happened in Israel. There's a slowdown in 2012. So you have these negative, I'm going to argue, supply shocks, the financial crisis, some commodity prices in 2012. Some things go on. You see growth is generally positive, but there are some swings. And here's what's interesting. Here's what's happening to inflation. Inflation is almost a mere opposite. So in 2009, when real GDP goes down, inflation goes up. When the economy recovers, inflation goes down. So what we see is counter-cyclical inflation in Israel. Now, this is, I think, unintentional. I don't think they're purposely aiming to do this, but they're doing it in such a way you're creating counter-cyclical inflation. And the amazing thing is, if you take the average over this period, it's 2%. They're still hitting 2% inflation on average over the medium and long term. But in the short term, there's flexibility. They're getting that symmetric inflation target, but it's more organic. Now, I share this with you because the product of those two things creates nominal GDP. And so if you look at actual nominal GDP, it's practically a straight line during this time. So something like a nominal GDP level target would create the kind of, I think, countercyclical inflation that the Fed really is aiming for in its discussion of makeup policy. Now, again, I'm going way beyond what Allan Meltzer would probably advocate at this point. But I do think he'd have some appreciation of makeup discussion. All right, I'll end there.
Thank you very much, David. Before we go to Ed, I've just got a question. Would Allan Meltzer not have had a problem with the Fed missing its target between the period 2008 and 2019? Because you can't say it wasn't for want of trying, that never before had they expanded the base money the way in which they had done. That, as I mentioned, they increased their balance sheet by $3.75 trillion, yet they were still getting inflation. I'm not sure that we can say that the deflation, there's something else going on. I would suggest that it could be that the Fed is responsible, but in a different way. It's responsible for having created an asset price bubble. The asset price bubble bursts. You then get a lot of financial stress. And then when you pump the money in, it's not getting transmitted in the way that you'd like it to do. The banks are just hoarding the money. So, I'm not sure that you can make that link between there's some sort of disconnect between money supply, at least base money, increasing a lot, yet inflation is doing nothing.
Reply to that?
No, absolutely.
Okay.
I'm asking a question.
Sure.
I'm not making a statement.
Okay. First off, we're talking about a whole decade, right? So maybe I could buy that story for a year or two after the crisis. Talking about a whole decade. But I think there are a number of shocks. The Great Recession, I think safe asset supply, the demand for safe assets contributes to this. I mean, some of the Fed's stories have credence to. Amazon. There are real supply-side shocks that come along. The question is, why isn't the Fed responding in a systematic manner to them to offset it, to get it to where it is? And that'd be my first point. The second thing is, even though we see a big balance sheet, the way I look at it, the Fed was effectively sterilizing that increase by paying interest on excess reserves during most of that period at a rate higher than you'd see in the overnight markets. So, Allan Meltzer, his vision is of, maybe Ed wants to weigh in and correct me if I'm wrong here, but his vision of monetary base injection, I think, is very different than what the Federal Reserve was doing. They're doing, as Bernanke said, credit easing. They weren't focusing on the liability side and increasing high-powered money. So I think they were at a crossroads there. On one hand, they were increasing the base, but they were also creating incentives for it not to become high-powered money.
The other panelists should feel free to respond to these questions.
I never heard Allan speak much about the inflation rate being too low. He was never really big on the inflation target per se. Remember, he was more the instruments, money growth, and so I may be missing things, but I spent a lot of time with him. That was not something he focused on, and of course, it took a long time before the Fed moved to 2%. Greenspan didn't want to do that. Volcker didn't want to do that. They were happy. Inflation's low enough. Inflation's low enough so it doesn't interfere with the economy. I always think it was 1.5% for Greenspan and Volcker. Who knows exactly? But they resisted the numerical number, and I think one reason to have resisted, it's there now, and other central banks have it. So I think that's where we are. But it did take away a little bit from the strategy you were achieving. You were working to get that. In fact, Ben was not really a fan of rules. He's written a lot about it recently. But that inflation target, he would argue, well, once you have the target, you don't have to say anything else. You do the target. We'll do everything to get that target and let us decide what to do, which is a different way to think about it than Allan. I think that's changed, but it could be that too much focus, and Volcker doesn't like the focus either on the 2%, even now, even today. It could have taken away from the strategy that you have to get the target, because both are very important.
Thanks. Ed?
Okay, well, I'm very pleased to be here to talk about Allan Meltzer, who was very important in my career. I first had interaction with Allan Meltzer when I was actually still living in Sydney, Australia, before I started graduate school, and corresponded with him. And he was very available when I then became a graduate student at Carnegie Mellon University. And I don't know if you know much about the way the business school is set up at Carnegie Mellon, but it does not have a huge monetary economics cohort. It's really, in the 70s, it was basically Bob Lucas and Allan Meltzer. And in the 80s and 90s, it was basically Ben McCallum and Allan Meltzer. And when I came over as a graduate student, it was Ben McCallum, Allan Meltzer, and me. So I had a lot of access to these very eminent monetary economists. And it was really something that I was very fortunate to access. And so one thing I should stress before I go on is that I'm here as a researcher and as a student of Allan Meltzer rather than as a representative of the Federal Reserve. I'm not speaking on behalf of the Federal Reserve, and that will obviously limit what I can say about current policy. And what I will say today will be more on the retrospective side. In particular, I'll be talking about the intersection of two subjects in monetary analysis that are associated with Allan Meltzer, and that got me interested in his writings well before I first met him over 25 years ago. These topics are monetarism and monetary policy rules. I'd like to consider first where monetarism fit into Meltzer's advocacy of monetary policy rules. So for many decades, as you know, Allan was an advocate of using a monetary quantity, such as the monetary base, as the policy instrument. Indeed, until the late 1980s, he favoured moving to a policy rule that consisted of a fixed rate of monetary growth. This advocacy of a constant monetary growth rule was tied to a view of the transmission mechanism, but not to the way an emphasis on money is often presented in textbooks. Meltzer's emphasis on money didn't come from any strong belief in structural money channels going to spending, bypassing interest rates. In particular, he didn't believe in what's often called the Pigou or Potemkin real balance effect. He didn't think that was very important for understanding business cycles. He thought it existed, but he didn't think it was really the driver of the business cycle. Nor did he subscribe to the position that the money demand function was interest inelastic, which is a position, if you remember ISLM diagrams, is one that would have implied a straightforward direct relationship between money and income. Rather, he believed that monetary policy affected spending by the effect of monetary policy actions on securities market interest rates and also on a broad range of other asset prices. In this respect, his and Karl Brunner's view of the monetary transmission mechanism mirrored that of some Keynesians, obviously James Tobin be the most prominent example. But unlike Tobin, Brunner and Meltzer believed that monetary growth provided a good summary of the overall movements in key asset prices, and so the stabilisation of monetary growth would be conducive to stabilisation of growth in real and nominal income. So that was how Allan Meltzer got to a constant monetary growth rule. I'll consider now the evolution of his views on rules, which moved him toward a more favourable perspective on rules that did use the short-term interest rate as the policy instrument. So he'd long acknowledged that a short-term interest rate could in principle be workable, could be stabilising, but really only late in his career was it that he perceived an interest rate instrument as a valid and perhaps superior alternative in practice to the use of quantities as the instrument. And monetary policy developments and economist research findings ultimately convinced Allan that interest rate policies that were stabilizing were more achievable in practice than he had thought. In elaborating on how he changed that view in this way, it's worth mentioning that he didn't put particular stress on the discretion versus rules distinction as the way of framing the debate. Perhaps surprisingly, he and Karl Brunner expressed dissatisfaction with a label like that, and Allan preferred to think of every policy as being a choice of rule. In this way, he recognized that the interest rate policy followed by a central bank was or could be a rule, that is, that the central bank's interest rate reaction function is its rule. He also appreciated the fact that a rule for the interest rate could, in principle, achieve control of monetary growth and inflation. As a practical matter, however, for many years he was very sceptical about whether the features needed for an interest rate rule to work really existed. Allan particularly doubted whether central banks had, first, sufficient information about the economy's structure, and secondly, the readiness to move the interest rate sufficiently and promptly. And so these matters featured prominently in US monetary policy discourse in 1979, when, as we've already discussed, the debate on Federal Reserve policy was at a crossroads. Meltzer, in his history of the Federal Reserve, noted that in the 1970s, the FOMC used the federal funds rate to pursue targets for monetary growth, and he observed that the FOMC routinely attained its desired interest rate settings, yet frequently missed its intermediate targets for monetary growth, which these settings were intended to achieve. In 1979, for example, he contended that in practice the FOMC just did not seem able to find the right interest rate target to get control of monetary growth. In 1981, he outlined his concern in these terms that central banks are in a tough situation when the private sector's demand for credit undergoes declines, because this puts downward pressure on market interest rates, and central banks try to delay the fall in interest rates by slowing money growth. Money growth collapses as we enter recessions, and since the era is symmetric, money growth soars during expansions. So what was needed for better monetary control, he suggested, was an arrangement in which market interest rates were permitted to adjust more promptly to evolving economic developments. So for a long time, he saw the solution to this in the central bank stepping away from management of interest rates. The proposed alternative Allan offered, and that other monetarists offered, was that the central bank should target money using the monetary base as the instrument. The interest rate movements consistent with control of monetary growth and ultimately of inflation would then occur automatically. Meltzer recognized that irrespective of what monetary policy procedures were adopted, a period of a higher federal funds rate and of recession was inevitable if disinflation was to occur, starting from the conditions of 1979. As it happened, Allan was in the years that the early Volcker years was extremely critical of monetary policy, even though it centered its operating procedures on control of a particular reserves aggregate. But he would, in his retrospectives on the early Volcker period, soften his criticisms, particularly of the early 80s portion of the Volcker period, which he came to see as a prelude to an enlightened employment of an interest rate reaction function during the 1980s and 1990s under Federal Reserve Chairman Volcker and Greenspan. And during the early 80s, Allan showed some signs of the thinking that led ultimately to his acceptance of some interest rates as viable. For example, he saw that interest rate policy could be marshalled to establish a firm resolve against inflation. He pointed to the early Thatcher experience in the United Kingdom and said that the steps taken under the Thatcher government in 1980 reinforced the belief that a change in policy has occurred because it showed a manifest unwillingness to reduce the UK policy rate despite rising unemployment. During the 1980s and 90s, Meltzer acknowledged instabilities in the monetary growth, nominal income relationship, particularly over the short to medium run. But his initial inclination was to recommend the Federal Reserve follow a policy of adjusting its monetary growth rules for velocity shifts rather than to follow interest rate rules. However, over the same period, he was exposed to Ben McCallum's favourable theoretical analysis of interest rate rules and later to the economics profession's discussions of the Taylor Rule, a rule that, as John mentioned, was first presented by John at the Carnegie Rochester Conference Series in November 1992 in Pittsburgh. The considerable US economic stability experienced with an interest rate instrument in the 1990s, I think, swayed Allan still further, especially as it occurred against the background of fluctuations in monetary velocity, whether you're talking about the monetary base or for broader aggregates that include bank deposits. By 2009, in his history, Allan's considered account was that monetarists should have put more stress on the scenario that appropriately formulated interest rate control would be effective and would be countercyclical. The theoretical appeals of interest rate reaction functions, he now acknowledged, had considerable empirical backing. He saw the FOMC in the late 20th century as well described as following a Taylor rule and indicated that this had been associated with economic stability. So Allan ended his many decades in monetary economics being much more receptive to interest rate rules. So that's really the one key aspect of his thinking that shows an evolution, but also shows that he stuck to basically a monetarist view of the transmission mechanism. And I discussed this evolution in his views a bit more in the book.
Would you care to speculate whether he would have thought that there are limits to how useful interest rates are when they become negative? You know, so for instance, like we've got the ECB right now, it's reduced its interest rate to 0.5%. Is there very much further that one can go, or do you run into problems that it messes up the banking system and it reduces credit flows in that kind of sense? My question is, would he have thought that there are limits to how far interest rates can go negative?
Well, with Karl Brunner, Allan wrote a couple of technical papers that were very critical of the idea of a liquidity trap. In other words, he thought that the central bank's ability to influence quantities ultimately will leave it in a position to stimulate the economy, even when short-term interest rates are very low. So in terms of why he thought that was the case, he really viewed monetary policy as capable of affecting a whole multiplicity of asset prices in the economy. And in fact, one of the interesting things about monetary policy in the last decade is that although Allan obviously was very outspoken in being critical, particularly of the Bernanke years, a central foundation for the QE programs was the theoretical basis that the work of Brunner and Meltzer and James Tobin provided, because they argued that if the central bank purchased securities whose interest rates were positive, that would put downward pressure on those securities interest rates. And so he thought there was still scope for stimulating the economy even when short-term interest rates are near zero.
Right, I've got no doubt that they can do that and that in fact they did that, but doesn't that come at a price? That what you're doing is you're distorting asset prices and setting yourself up for the next bust? You know, I mean, it's not just asset price. You know, that if I look at today's world, you know, that what my concern is that not only do we have asset price bubbles in a variety of housing markets or equity valuations, we've only seen these 3 times in the last 100 years. The more serious problem is that you get loans flowing to countries like Italy or to Argentina at ridiculously low interest rates, or you get leveraged loans, you know, that the credit risk is not being priced properly. You know, you're setting yourself up for the next bust.
Well, I'd be interested in what my fellow panelists have to say about it.
Okay, well, let's...
I dare say if central bankers believe they could get a bubble going for as long as this last expansion has been going on, they'll just want to keep trying. I have my doubts, though. Is it my turn?
Yes.
Oh, very good. Thank you, Desmond, so much for this opportunity. I'm very honored to be sharing this event with such distinguished speakers, all of whom I suspect, including David, who's younger than me, actually spent more time with Allan Meltzer than I did. I certainly knew him and met him on several occasions, but I'm probably less qualified than anyone else here is to speak about what Meltzer would have thought about whatever. Nevertheless, I'll venture to say I think that if he were confronted with the current situation, he would be appalled, but not surprised. He wouldn't be surprised because he wrote a wonderful, extraordinary book about monetary history. He knew his history. He knew that the Fed had done a lot of appalling things over the years, and he knew that history, monetary history, like other kinds, if it doesn't repeat itself, at least rhymes, to repeat the old quip. He also knew particularly that Fed officials hate admitting mistakes. Some others here have written about that, and that they'd even rather compound those mistakes than correct them. Rather than admit that they actually ever did anything wrong. So I don't think he would be surprised to see that things in some respects have gone from bad to worse since the 2008 crisis. That crisis, nevertheless, must have shattered many of Meltzer's long-standing basic beliefs about monetary policy and the monetary transmission mechanism. And I want to talk about that and the ways in which things have changed contrary to the way that they were understood by Allan. And I wanted to talk about how we might react to that change today. As you heard, Allan was a monetary base guy, fundamentally. He was a monetarist, of course, but he was a monetary base guy. That meant essentially that he thought the most important measure of money was the size of the Fed's balance sheet, essentially, and that the thing you needed to control all other nominal magnitudes, price level, total spending, whatever, the broader measures of money, was how rapidly the Fed's balance sheet grew. He believed in particular, at least until the crisis he believed, because as I'll point out, he certainly changed his thinking afterwards. He believed in what he called, and what many called in those days, a stable base money multiplier, that is a stable relationship between the size of the Fed's balance sheet, which determines both total bank reserves and the amount of paper currency in circulation, and the size of broader measures of money that include all bank deposits, etc. So he believed that that was stable. All right, so today, of course, as Desmond has emphasized, we have a Fed balance sheet that's over $4 trillion and counting, which is 5 or something times as big as it was before the crisis. And yet, instead of having a lot more inflation, as the old stable multiplier view would have it, we have below target inflation, have had persistently below target inflation. So lots of creation of base money, no corresponding increase in prices. And this has been going on since 2008, essentially. I should say, by the way, that I don't think Allan would mind at all the fact that we've been falling below 2% inflation, but I think there's a very prosaic answer to that. Having been an old-fashioned monetarist, he never bought into the view that 2% inflation was desirable. I think he would have held out for the older monetarist idea of zero, and until it goes below that, well, everything's fine. And better that it should get there. I'm not agreeing with that, but I think that that's the simple answer to what he would think about 1.5% inflation instead of 2%. So no biggie. Now, he was caught off guard by the events following 2008, and he, to his credit, recognized the fact. Meltzer was one of those who, when the Fed began to quantitatively ease, can we say it that way? Well, it'll let it pass, that he anticipated that all this new base money creation would lead to inflation. That is, it wouldn't just get us out of the recession and get us out of what had been a brief deflationary episode. His expectation was eventually all this new base money is going to have to cause prices to rise proportionately, unless, of course, the Fed takes it back. The Fed never did take it back. Prices never rose proportionately. They still haven't risen that much today. And he acknowledged that in fact, the old way of looking at things with its fixed multiplier, that no longer worked. This is a tremendous sea change from the whole way of viewing monetary policy and the transmission mechanism from central bank actions to the rest of the economy that had informed what was up to that point, I think you can fairly say, Meltzer's life work. So that's a big deal for somebody. Well, I think he took it in stride. Monetarists are very good at doing that sort of thing. I have to relay here an anecdote that's a little bit off the subject about a different monetarist. I was with Milton Friedman in Shanghai one time 1989, we were at a conference, but we were all taking a walk with a Chinese hostess through old Shanghai. And this was during a transitional period when there were many private stores and there were public stores. And the guide was pointing out that some stores are private, some are public. And looking at a particular store, Friedman said, oh, yes, well, it's obvious that that's a private store. And he went down a list of about 5 or 6 pieces of evidence that made it clear that that was a private store. And the guide says, well, yes, Professor Friedman, but that actually is a state store. And he said, well, of course it's a state store. And he came up with another list of that. Anyway, these monetarists are quick on their feet, and so was Meltzer. And he certainly recognized his error, etc. There's a doctrine called Goodhart's law in monetary economics, named after Charles Goodhart, that I hope I have this right, but it says that you can think you have a stable relationship in the economy, but if the central bank tries to use that, to exploit it, that very fact could cause the relationship to come apart, and no longer trying to follow it or use it no longer has the results you might hope. And that's true. That can happen. But it's also true, and I think this is something that Allan recognized, that central banks can also destroy stable relationships deliberately through their deliberate actions, not because they're trying to use them to some purpose, but simply because they don't like them or they don't want them to hold. And that's exactly what happened to the multiplier in 2008. We have to step back and remember that, and this is really tough to remember because it seems so perverse in retrospect, that from the summer of 2008 right up until the fall, the Fed officials were worried about inflation. There was some rise in prices at that time. It was all in mostly oil, commodities. They should have known better. Their own professed ideal price index leaves those prices out, but never mind. They were worried about headline inflation. But they were also bailing out banks, creating base money, expanding the balance sheet. And therefore, they wanted to make sure that creating all this base money, which they felt they couldn't avoid doing because of the crisis, the financial crisis, that the base money didn't do what it usually did, which was to fuel growth in broader monetary aggregates and ultimately raise prices. So the first thing they did was they sterilized their emergency lending. They did this for months. That meant that as they made emergency loans to the banks, they also engaged in open market sales of securities from their portfolio to take back as many reserves as they were creating and keep their balance sheet stable. After the Lehman's failure, the amount of emergency lending jumped way up, AIG, et cetera, not because of Lehman's, of course. They let that fail, but there were other rescues afterwards that were huge. At the same time, they'd run down their portfolio of their securities holdings. So they couldn't sterilize all that in new emergency lending that way. That's when they started paying interest on reserves. It was an anti-inflationary measure at a time when, again, even in October when they started, by that time the economy is going down the drain, but they still went through with it. This is typical, right? Don't change your mind just because events have changed. And as a result, they started paying interest on reserves so that when they were creating more base money, it would just stay in the banks and wouldn't promote corresponding expansion of broad money, lending, spending, all that. They killed the money multiplier, in other words. They killed it. They made it 1 instead of some actual multiple of 1. And it's stayed there ever since. They did this on purpose. They did it on purpose. So, of course, if central bankers seek to destroy a long-standing relationship that a good monetary economist has been working with, has understood, etc., that makes life difficult for good monetary economists. And that's the sort of thing that he confronted. Now, anyway, today, of course, the situation remains more or less the same. The Fed has decided to permanently keep this arrangement with interest on reserves, to permanently keep an arrangement that not only doesn't cause expansion of the balance sheet to lead to inflation, but makes it possible for a central bank to have a huge balance sheet and not have enough inflation by its own, according to its own criteria, and even allows it next month we'll see it start creating another couple $100 billion of base money to correct problems it's been having with this new system. And that won't be inflationary either. Now, I think, to go out on a limb and say something about what I think he'd make out of this today, a bigger limb than I've gone out on so far, I think that Meltzer would, and it's always, whenever you're asked to say what another economist would have to say about something, and that person isn't around anymore, you invariably are tempted to say, well, he'd agree with something I care a whole lot about, and he would take my side on this. Sure enough, I'm about to tell you that I think he would have joined not just me, but David and John. I'm not sure how you feel about the corridor versus the floor system, but I think you too would be on this, that he would want the Fed to undo the change in the monetary system that it put into place way back in the fall of 2008 and reestablish that old monetary transmission mechanism where expanding the balance sheet actually did something other than allow the Fed to gorge on all kinds of assets. I think he would be disturbed, as many of us are, about the political economy of this new setup, about the unlimited capacity, seemingly unlimited capacity of the Fed to buy this, that, and the other thing without generating inflation. I think he would want to restore the old, or many aspects of the old system, not simply so that the old Allan Meltzer theories would work again, but because that system actually itself was far more reliable in allowing the Fed to do what it's supposed to do than the current system is. And of course, we're hearing every day in the news how the current system is not delivering the goods. So that's what I think he would have said.
Thank you very much for that. Just before I throw it out to questions, if we could come back to the question I asked at the start, should the United States economy, should the global economy go into recession, what kind of advice would you be giving the central bank now, where the interest rates are at very low levels? There's not a whole much they could do. If I understand you, you'd be wanting to get rid of the interest payments on reserves? Or?
No, not exactly. You can pay interest on reserves and still have and still maintain an incentive for banks to lend those reserves. As David suggested, what matters is it's not essential that reserves pay no interest. It's essential that they not pay so much interest that they are more attractive an investment than treasury securities and bank loans and other things. In the old system, reserves always carried what economists call an opportunity cost. That is, the banks held them when they absolutely needed that liquidity. But if they didn't, they had better investments that they would take advantage of and would part with those reserves. Of course, the reserves wouldn't disappear. Other banks would get them. But that's this multiplier thing that Meltzer talks about. No, I think you would lower interest on reserves enough to recreate that setup where banks don't hoard reserves. But switching to that kind of Swiss system from the system we have today, that's one decision. The other decision, which is actually separate, is what should the stance of monetary policy be? Because in any operating system, you can have any monetary policy stance, more or less. And there, I think I probably would not be in agreement with Allan, who's much more of a hawk than I am. I think probably the Fed is justified in having rates about where they are, given the way the world is, and probably will be justified when it lowers them another 25 points at the end of the month, which I'm pretty sure it's going to do. And that's because, for better or for worse, there are demographic and other forces that are, as it were, the market tail that's wagging the interest rate dog. And the Fed can't try to keep rates up even when they're tending to fall elsewhere, where the Fed is only able proximately to control its own a couple rates. Nowadays, its interest rate on reserves and its repo rates. and it can only make the discrepancy between those and prevailing market rates so big before it starts causing problems for itself and others. So it really has to gauge what the market rates are tending to do and what they need, and follow along to the extent that that's consistent with its inflation targets.
So I think the question is, what do they do if there's a recession, isn't that? And
Right.
so
I'm just thinking that, starting with inflation so low, with interest rates so low, if we now go into recession, what do we do?
So they're working on that for what it's worth. I think it's a good sign. Not surprisingly, they're looking at different strategies for setting the interest rate. And so if you look at the research at the Fed, as far as I can tell, also, I mentioned other people working on this, they're looking at different rules or strategies to follow. And one which is a popular one is after David Reichenauer and John Williams, actually 20 years old proposal, where they would hold the rate, not negative, but hold the rate somewhat above zero, maybe 25 basis points, but for longer than otherwise. And the degree of length is well specified by the time that you would be at the zero bound. So you use a Taylor rule or whatever you want to use, and that suggests a negative number. You don't go negative. They think that's a problem, I agree with. So you hold it at 1 or a half or a quarter, and then you keep it lower for longer afterwards. It's a rule. It's a very precise rule, and maybe it's too precise, but that's an example of what they're doing. And I think that's one of the reasons why you're seeing so much more research on rules again. Because they have to, what are you going to do? You have to, and it could be QE. I think there's really doubts about the impact of that, so that's it.
Might helicopter money be an idea?
It's an idea, all right.
I mean,
What do you mean? Why don't you define
idea,
why don't you define it, and then we'll answer it.
Well, what I mean is that the central bank provides financing for the distribution of money by the Treasury to people who are likely to spend the dough. Because that would get around the problem of distorting credit and asset markets, again, just setting us up for the next bust.
Well, I mean, you can't have it both ways. If monetary policy really is distorting markets, it's because somebody is using the money and is lending it and is buying assets, and the private market is putting it to work. If the problem is the private market's not putting it to work, then helicopter money is an alternative, not designed to avoid bubbles, but it's designed to avoid doing nothing. That is, it's designed to give the central bank an alternative to trying to lower interest rates when it can't.
I guess what I'm suggesting is that maybe the fundamental problem is that too much of a burden is being placed on monetary policy, and that
yes.
If you had a better designed fiscal policy, with monetary policy support, you'd be able to get the recovery without distorting markets in the way that we've distorted them now, and set us up for a bust.
Well, I think helicopter money is really a sort of a fifth wheel, because if the fiscal authorities are really prepared, let's say the fiscal authorities are prepared to engage in expansionary policy because there's a recession, let's assume that that's what they care about, as if they wouldn't do it anyway, and then they spend the money, unless the Fed is itself determined to keep an overly tight rein on money. If it too is concerned about recession, it will accommodate that spending one way or the other. So there's no need for a concerted effort of helicopter drops or what have you.
Let me talk about the assumption in that question, and that is that the Fed has been the source of the distortion, the low rates, as opposed to maybe being global forces that are driving rates down. George mentioned demographics, the savings flowing from poorer countries to advanced economies. I do think, I guess, that would happen independent of these big balance sheets to some extent. On the margin, they've contributed to it, but I do think that that's a development that's occurring despite central banks' best efforts.
I think we can take this further. I should throw it out to questions, but I just go back to Our problem today is the Lehman crisis. That you had a big bust, that you then had the Fed swooping up all of the low-risk assets, and now what you've had is you've forced the markets to go out and lend to countries or to companies that they shouldn't have been lending to, or at interest rates that they shouldn't have been lending to. So when we get the correction, we're going to have another round. We're putting ourselves in a position we could have another round of an asset price bust and credit market. The problems will be different. This time they might not be in the banks, they could be in the non-bank sector.
I do think, just before we go to the one fair point you're making, and that is the influence of the dollar and the reach of the Fed. The Fed is a monetary superpower. A lot of countries peg implicitly or explicitly to it. The world has to follow what the Fed is doing. So I do think the unintended consequences of Fed easing or tightening do go around the world. The dollar, for better or for worse, is this beast that's everywhere. And I'm not sure how you fix that, other than other countries getting their house in order.
Well, what we do is we have a do-over.
All right.
But let me
So I think actually, I think the central banks themselves are what's causing the rates to be low. I mean, you are charging a negative interest rate in Europe and in Switzerland, and it's near zero in others, and that it's expected to be low for a while, so it'll affect longer-term prices, it'll affect bond prices. That's, to me, the number one cause of negative interest rates. It's caused by central banks. We can debate it. We can say it's demography or excess global savings. I don't think there's much evidence for that.
But wouldn't you say that if we look at the ECB that's got negative interest rates, that the reason you've got negative interest rates is that Germany has again gone into recession. The others are all on the cusp of a recession. They're seeing the economy slowing. And what is occurring is that the German government believes in this black zero that balance.
So just to
that
interrupt,
budget has to be balanced under all circumstances.
Right now, I don't think it matters. We can debate the reasons. They've had negative interest rates for a while. It's not just the last year. We can debate the reasons, and we probably have different ones. But I think that's the cause of the low rates. That's the main cause of the lower rates. And in Australia, they have a 1% interest rate. At a similar situation, a cycle going into this Great Recession, they had 4 or 5%. It's a different policy. And if you look around the world, it's the same thing. So to me, the way you get out of this is you try to normalize policy. It's thousands of years with no negative interest rates. This is a very new thing, and we can get out of it if we put our mind to it. I think it would be better if we did.
So John, if the Fed right now were to decide we don't want to head down further toward the negative interest rates, we want to raise rates. We want to do, since if you believe the Fed, central banks have made the rates as low as they are, presumably they can make them higher. But how would they do that? What would the Fed have to do right now to raise rates?
Well, I'm like you. I wish they were in the pre-2008 mode in which they just reduced the reserves a little bit. They're not there. We hope they get there, but they're not there. So in the meantime, they raise the interest on excess reserves. That's the only, because if they don't do that, the rate will go to zero because there's so much supply. Also, you got this recent problem of not really understanding the demand for reserves. But I think at this point, we're in a situation, it was like we were recently. They had a higher interest on excess reserves, and the interest rate was higher, and they lowered, and the interest rate's lower. So that's the only mechanism that's practical right now. Ultimately, yes, I'd like to go back to 2008, where there was a relationship between the supply of reserves and interest rate. It was a beautiful world. It was a discipline. I'm sorry?
We didn't think so back then, did we?
Well, I loved it. Are you kidding?
Oh, that's
I went
right.
to the money markets. I studied. I worked with traders.
I keep forgetting they were doing what you wanted, what you described them as
worked.
doing.
It worked just fine. We had a great moderation.
Yeah.
Whatever.
Let's take a few questions, and we'll end it. Maybe we'll just take a round of questions. Bert.
Bert Ely, a banking consultant. I have a question for Mr. Nelson, just to see if I heard this correctly. That you thought that Allan saw some value in central banks stepping away from influencing interest rates. Is this another way of saying that maybe central banks shouldn't be in the business of setting interest rates, and that economies should rely on the financial markets to set interest rates across the yield curve?
Well, certainly before, let's say, around 2004, around then, his preferred rule was one in which the central bank sets the monetary base. He wasn't even reserves. He preferred the monetary base as the instrument, but he would have been happy if total reserves was the instrument too. One has to be careful in saying that is making interest rates not a function of what the central bank does. Interest rates are always going to be a function of what the central bank does. But the instrument, the variable on which the central bank makes decisions would be the monetary base, or would be some aggregate reserves measure. So he was very, that was his primary analytical series for measuring monetary policy, as George said, the monetary base, but also he believed it should be instrument of monetary policy. Over time, with problems related, for example, to foreign holdings of currency, there were problems with the velocity of monetary base, and so he did, to some extent, become sympathetic to ideas that the quantity should not be the instrument or target of the central bank, but he was still very much more interested in quantities than the profession as a whole, obviously. But he, up till quite late in his life, he was an advocate of quantities as the central bank instrument, and was very critical of the Federal Reserve for not using the monetary base or the total reserves as an instrument. And even when the Federal Reserve had a reserves aggregate as its instrument in the late 70s and early 80s, he was critical of that because for him it was the wrong aggregate. It was non-borrowed reserves, and he would have preferred a total reserves aggregate. But he did become, as I said in my talk, he was won over ultimately by the arguments for interest rate rules, and was very amenable to the idea that the Volcker and Greenspan use of the interest rate as the instrument had been successful.
Any other?
I'll give you a choice of two questions. This is for David Beckworth. The first option is, what did Milton Friedman think about Bernanke's QE2, and then the follow-up that you postured from Allan Meltzer? That's one option. The other option is, when Janet Yellen said that she would let the economy run hot so as to improve the labor market, would you say that was a political error that has influenced the course of what you're talking about today?
Well, I'll respond to the first one. I'm sure there'll be some disagreement up here on the platform what I'm about to say. But what I argued in that piece was I drew upon Milton Friedman's talk he gave at the Bank of Canada, I believe in 2001. And I think he also has a piece in the Wall Street Journal, but definitely in the Bank of Canada in 2001, early 2000s, where he made the case for something very much like large-scale asset purchases. He argued, it was a Q&A like this, that he gave a talk, and they were asking, what can you do in Japan? Japan had experienced its problems, and he said, well, just start buying up bonds, go long on the yield curve. And he actually talked about going out on the yield curve, buying up more bonds. Now, he never saw this happen in the US, obviously, but he at least entertained the idea. And I don't know if he would have done it the same way that it was done here. Maybe he would have done it differently, but he at least was open to the suggestion back then. And that's the point my co-author and I made in the piece, that he at least had thought about this possibility in an environment where you hit the zero lower bound.
So I had the opportunity to talk to Milton quite a bit during this period. And first of all, although he was a monetarist completely, he was comfortable with the Taylor rule, with interest rates. And he would frequently describe it as it's a way to get money growth stable. It's fine. We had long debates about it, and it's a wonderful person to talk to. But he was not a fan of this policy at the Fed, and I wrote about it in a recent book. And you can see why. It wasn't like he was out there screaming all the time, but he was not happy with it. It was not very rules-based. I think it was really deviating. So you can see what he thinks. I think in terms of running the economy hot, that's from what Janet is saying. Janet's for years has been, even before she was a member of the board, was very positive about rules and policy rules. So I think she's always been in that mode. So I don't think she means having the rate higher than a rule would be, or lower than lower than a rule would be. She recognizes that rules are not perfect, of course, and she ran the Fed for quite a while in that dimension. But remember, my description of the Fed normalizing began when she was chair. It was in 2017, I think it was, and they started publishing rules. They started talking about it, and there was a big change. It continued in 2018. Jay, I think, continued that. So it began. I would have argued it occurred earlier, but it occurred at that point. And she was the chair of the Fed at the time. She was trying to do something different.
But she's now recognizing that a problem of those policies is the creation of a $1.3 trillion leveraged loan market, that's where credit conditions are very poor. So she's now concerned that these policies of keeping interest rates too low for too long has led to a problem in one segment of the market. My point is that many problems, globally, that these policies, I just have difficulty getting my head around, a country like Italy being able to borrow at a lower rate than can the U.S. But just on the inflation, if I can go back to the inflation question, there is a problem of inflation going too low. That I can see that if you've got debt and you've got big public deficits around the place, how do you stabilize the debt level if you now have deflation?
Well, I think another concern with inflation going low, and to be clear, I'm not claiming Allan Meltzer said he was worried about the low inflation, but if he were, I was conjecturing, given his thinking on the 70s, you could flip it. But I think a concern with low inflation is you have that concern, the debt burden, but on top of this, the credibility of the target. If it continues to drift down, it's about 1.5%. But in Europe, some people have suggested, well, let's just lower our target. But if you lower your target, then what signal does that send to the market if it drifts a little bit more? And so I think it's really important that the credibility of the target be maintained. And so it may only be 50 basis points, but I think that's consequential over the long period.
Or get rid of an inflation target altogether, as you have recommended, and instead embrace a target that could allow the price level to fall a little bit more quickly, but would only let it fall when it was not having the same debtor-creditor problems that Desmond was mentioning.
When you say get rid of the inflation target, you mean go back to where it was with Greenspan of Volcker?
No, I mean go to an NGDP target, level target.
What do you do? What do you do with the interest rate then?
Just to keep NGDP
You still
on target.
have a Taylor rule. You
still have an NGDP,
you still use an interest rate rule. You would just target, instead of the output gap in inflation, you would have maybe a nominal GDP term
cap
in there.
Good. Okay, let's just take the last two questions and then we'll wrap it up. We'll take them together. The mic will come to you.
Should I go first?
Go ahead.
Yeah, my name is Carl Polzer, and I started a project called the Center on Capital and Social Equity, which I really focus on the bottom half of the economic spectrum. So my question is about to what degree the inability of the bottom half to purchase, necessities like housing reduces the effect of what Keynes has been talking to me, and I'm self-teaching on it, macroeconomics. I'm not sure how much of it's getting through to me. But he seemed to be talking about this effective demand. If it's not there, then the investors aren't going to invest because they don't see a potential profit. And he distinguishes the interest rate from the monetary system from the rate of capital.
Right.
So that's where would policies that give people more spending power help stimulate the investment? And would that do more than what the Fed can do?
Okay. We'll come to that question. Sorry.
I wonder if John or George could speculate on how long it should take for the Fed to normalize its balance sheet when it had recently to reverse the withdrawal of quantitative easing because of the repo market and the concerns over activity. Thank you.
So I think, I don't know what George said, I think they were on a track of reducing the size, and it was going okay. Lots of people started to complain about that. The word quantitative tightening came into the language, and so they slowed down, and now they're going to do something different. It's not Q, I don't know what they'll call it, but it's a little different. But I think it would have been a good course to continue, and we'll see. I think now it's a global issue. Other countries should do it too.
Supplemental organic asset purchases,
We can wrap it up.
known as SOAPs for short.
Okay. We're going to wrap it up. I just say that, to that question, that's the reason that I would think helicopter money would not only be a more effective way of dealing with the next recession, but it would also be a more equitable way, so that we wouldn't get the idea that asset prices, you getting the economy going through boosting asset prices. People who, fortunate enough to own the assets, are the ones who benefit and others get left behind. But I think that is a story for another seminar. So with that, I really want to thank David again for asking me to do this. And it's really been a pleasure to moderate at this panel.
Thank you.